When times are tough, people may look to gold as a safe haven investment. But as with all investments, there is an element of risk. In the case of gold, experts say investors should only buy from an authorized bank, gold dealer or retailer. It's also important to have safeguards in place to weed out fakes and to check on authenticity.
We can use a very sensitive weighing machine that provides the density. Second, we use a handheld XRF, which basically scans the surface of the bar and it shows basically the breakdown of different bars. And the third is an ultrasound machine where it basically scans through the bar, where should there be any adulteration of the bar, then it will detect there's some impurity in the bar.
But even if it is the real thing, gold investors could still become victims of scammers. Over the past decade, these have included gold buyback schemes from companies like Geneva Gold, the Gold Guarantee, and Swiss International. So how can investors spot these scams? Firstly, if a scheme promises a high monthly or yearly interest or dividend on gold, it should ring alarm bells, because gold doesn't pay interest.
All these companies which were selling in the way of giving a return had huge markups, ranging from 15 to even 25% markup over the prevailing gold prices. And they use those markups to basically pay those returns to the customers. So for every new customer that comes in, they basically use a markup to pay the next guy.
While markups are a red flag, discounts should also be viewed with suspicion. Some schemes lured investors with discounts. When the contract is due, they can sell the gold back to the company at the full 100% price.
For example, now the gold price is at 1,950. They say that you can purchase it at maybe a 5% discount right now. In most markets, we usually pay a premium over the spot price.
And then there are schemes that give a payout and promise to buy back the gold at the original price, regardless of how gold prices have fluctuated since then. In other words, investors get back their principal amount invested, plus earn returns at the same time.
For example, now you buy at 2,000 US dollars. Say in the coming month or coming year, if they go plunge to about 1,006, so there's a loss of 400 US dollars. So if they're going to buy back at 2,000 US dollars, then my question is that then who is going to bear the losses?
Scammers have evolved and become even more creative.
It required investors who had purchased the gold bars from the seller to deposit their gold bars with the company for inspection. And the companies will in turn resell the gold that has been surrendered by the existing investors to other investors, which end up to have more than one investors laying their hands on the same gold bars.
Digitisation has opened up more loopholes for exploitation.
More recently, you see a lot of digital currencies claiming to be backed by gold. If a company says that it is backed by gold, you should be able to identify where the gold is, number one. Okay. Two, what is the pricing? Should there be a high premium or high bid and offer spread? These are indicators to show you that it also may be a derivative, which is a paper contract to provide the offering first before they even transfer the derivative into a physical proposition. Should there be a physical backing? And in the most digital backed gold are fractionalized.
But it isn't just gold, the precious metal, that's been making headlines. The price spikes have also put the shares of gold mining companies in the spotlight.
The growth and return in the stock depend on the expected future earnings of these gold mining companies, not just purely on the value of gold. Factors such as effective management, production costs, reserves, mine exploration and project development, as well as hedging activities are some of the factors to consider.
But market watchers say these shares can turn out to be very risky investments.
The mining shares are based on a future mining production, which is a question mark. They probably have done their tests in terms of finding whatever reserves that is underground. Should whatever projection that they project do not come to pass, you also may lose a lot of money.
Investors are, however, drawing comfort from Warren Buffett, whose Berkshire Hathaway bought a stake worth about $564 million in gold and copper miner Barrick Gold. Mr. Buffett has been a long-time critic of gold, so this change in investment direction is sending strong signals to the market.
The case of gold mining stocks as well as gold equities has gotten stronger recently with the improving balance sheets, the costs of operating are broadly under control. The free cash flow profiles of these companies are also looking stronger, and the return on the invested capital of these gold mining companies are also relatively stronger, as well as the quality management teams